Hello and welcome to my morning note. We live in strange times and it's very difficult to see which direction the market is moving. My clearest indication of that at the moment is that following the latest round of downgrades, the Banco Santander of Spain now actually has a stronger credit rating than the government of Spain. And the reason for that is that Santander bought a large number of Latin American banks in very distressed circumstances. Often those now act as actually a positive diversifier for it, quite justifiably make it appear to be a stronger credit than its own government. Now, in such strange times, it obviously becomes ever harder to read the markets. 2 or 3 weeks ago, it looked as though we had embarked on a clear risk-on upswing. In the last few days, that has begun to dissipate a little. My guest today has, I hope, quite an optimistic argument that we could still be in the early stages of another risk-on upswing. He's Absolute Strategy Research's David Bowers. David, thanks for being here this morning. Let's start with this fascinating chart you've produced yourselves showing risk as an indicator. Take us through how you compile this.
Well, what we've gone and done is found 25 different risk metrics. Many of them are produced by the IMF and the BIS, usually only get updated once every 6 months. We've created a weekly indicator which basically puts all 25 of these measures together into one composite measure. That's the red line on the chart, and it shows you that we are really in quite extreme risk-off territory. It also shows you that on the previous 4 occasions when risk-aversion was this high, we did see a positive response.
For a bounce.
We were ready for a bounce. Now, what that catalyst is going to be is always the big question, but it does suggest that the market's more vulnerable to good news, given how pessimistic people currently are at the moment.
Okay, now, there are at least some decent reasons for pessimism even beyond the Eurozone crisis. If we take a look at this next chart, which you've also prepared, obviously commodity prices have been falling, and that appears to be linked to what looks like it could be a very ugly second quarter earnings season.
Yes, I mean, this is, I think, has certainly given the bears a bit more ammunition, which is that this collapse in commodity prices is very severe. CRB index down 20% or so, and historically that's been a good cross-check as to what's going to happen to earnings, and it does suggest that globally we should get ready for negative earnings growth. Now, that in itself is bad news unless we see policy respond.
Okay, which brings us beautifully to your the final chart that we've prepared here. There might be an argument that the emerging market banks, central banks, are ready to ease.
Yes. So one of the consequences of lower commodity prices and a stronger dollar is that inflation is on the point of potentially falling very, very rapidly indeed. You've got lower food commodities, lower industrial commodity prices, lower energy commodity prices. At the end of the day, there is scope here for major falls in inflation, both in the developed world and in the developing world. This chart shows you the current inflation rates in many of the emerging markets, and the blue diamonds show you the inflation targets that many of these central banks have adopted.
So China is actually below
So China's
its
inflation
target.
rate is below target, and we think that there is the chance that Chinese inflation could plunge from here. We think it could be below 2%, maybe even 1% before we get to the end of the year, and we believe that
thanks to those commodity inputs.
Thanks to those commodity inputs, and thanks to the impact of the stronger US dollar. And the question is, will this force emerging markets into a major round of policy easing? If that's the case, then maybe that's the white swan that impacts this very risk-averse environment we're currently in at the moment.
Okay, and then last week we saw the Indian central bank surprise people by not cutting, and people were disappointed by the Fed. Might that be the reason that things slowed down last week, that people are more nervous about whether we will be getting this easing?
Yes, I think if we don't get a policy response on the back of this decline in inflation, then I think the negative earnings story will continue to drag markets lower. But we think this is a challenge not just for emerging market central banks, but for developed markets as well. You know, the Bank of England's already being surprised by inflation coming in much lower than expected. In the US and the Eurozone, you could see inflation sub 1%. And I think this puts central banks on the spot again. They can't hide behind inflation is above our target. And that, I think, is where we should be looking for surprises as we go into the summer.
Okay, David, thank you very much indeed. I think the takeaway is, yes, we are primed for a rebound, and the people we need to watch very carefully to see if that rebound can happen is, yet again, the central banks.